Picture a sandwich so powerful, so cleverly constructed, it could make billions of dollars seemingly vanish from the grasp of tax collectors across the globe. Sounds like something out of a spy novel, doesn't it? But this wasn't fiction. It was a very real, very lucrative financial maneuver. For a solid decade, from 2004 to 2014, tech titans like Google alone managed to funnel over $100 billion through this exact sandwich, paying an average effective tax rate of just 2.4%. Think about that for a second. Less than what most school teachers pay in income tax. And Google wasn't alone. Apple, Microsoft, Facebook, even pharma giants, they all queued up, eager to order the same thing off this rather exclusive secret menu. The double Irish with a Dutch sandwich. Today, we're peeling back the layers, following the money step by step, so you can see exactly how this ingenious, if controversial trick was done before the loophole finally, irrevocably slammed shut. Get ready to have your mind blown by the sheer audacity of corporate tax optimization. Section 1. The problem worth solving. Multinational corporations were facing a rather inconvenient headache. Imagine you're selling a shiny new phone in Germany. You'll owe Germany a hefty 30% tax on the profit from that sale. Fair enough, right? But here's the kicker. If you then decide to bring that hard-earned profit back to your company's headquarters in the US, Uncle Sam wants another bite. That's a significant chunk of change disappearing before it even hits your balance sheet. The ultimate prize, therefore, isn't just to reduce your tax bill, but to find a clever legal way to park those profits somewhere that charges close to 0%, yet still call it entirely above board. This isn't about outright evasion, mind you. It's about navigating the labyrinthine world of international tax law to find the most advantageous route. Ireland, with its relatively low headline corporate tax rate of 12.5%, seemed like an attractive option. But for truly ambitious companies and their clever lawyers, that 12.5% was still far too high. They realized they could drive that rate down to almost nothing by stacking two Irish companies and, here's where it gets interesting, slipping a Dutch one in between. It was a masterpiece of legal engineering designed to exploit every tiny discrepancy in global tax codes. Section 2. Our cast of characters. Every good scheme needs its players, and this one had a carefully selected ensemble. First up, we have Irish Company 1. This company was incorporated in Dublin, which sounds very Irish, doesn't it? But here's the twist. Its board meetings, its actual management and control were strategically held in a sunny, low-tax jurisdiction like Bermuda. Why Bermuda? Because under Irish law in the 1990s, if a company wasn't managed and controlled within Ireland, it wasn't considered tax resident there. This meant it owed Ireland precisely zero in corporate tax, despite being legally incorporated on Irish soil. This entity was crucial because it held the crown jewels, the valuable intellectual property, things like Google's search algorithm, Apple's designs, or Microsoft's software patents, which had often been transferred to it from the parent company. Next, there's the Irish Company number 2. This one is a bit more straightforward. It lives, breathes, and files its accounts squarely in Dublin. It's definitely Irish, definitely tax resident in Ireland, and definitely owes the standard 12.5% corporate tax on its profits. This is the operational company, the one actually selling products or services across Europe, generating all that lovely revenue. Then we introduce our crucial intermediary, the Dutch subsidiary. This entity often existed primarily on paper, a legal construct in Amsterdam, perhaps with just a small office or a single employee. But don't let its modest physical presence fool you. It held a precious key. The Netherlands, strategically located within the European Union, had a network of favorable tax treaties and, more importantly, adhered to EU directives that effectively wiped out withholding tax on royalties moving between member states. This made it the perfect frictionless conduit. Finally, lurking at the end of the line, we have the ultimate destination, Bermuda or the Cayman Islands. These aren't companies, but rather the smiling, sun-drenched tax havens that charge no corporate tax at all. This is where the truly stateless profits would ultimately come to rest, safely out of reach of high-tax jurisdictions. Section 3. Moving the profit. Alright, let's get into the nitty-gritty of how the money actually moved. Picture Irish Company 2, our operational company in Dublin. It signs a contract to sell Google ads across Europe, generating billions in revenue. Every euro of profit that lands here would normally face that 12.5% Irish tax, remember? But the goal, as we know, is to shrink that profit as much as humanly possible before the taxman even gets a sniff. So Irish Company 2 signs a second, rather vital contract. This one is with Irish Company 1, the IP holding company managed from Bermuda. Under this agreement, Irish Company 2 agrees to pay hefty royalties for the use of Google's search algorithm, its brand, and its patent portfolio. This is where the magic begins. The royalty rate isn't just high, it's set so aggressively, so astronomically, that a staggering 90% of the cash immediately walks right back out the door of Irish Company 2. This practice, known as transfer pricing, is all about setting internal prices between related company entities to shift profits. So, where does this massive chunk of cash walk? Straight into the waiting arms of Irish Company 1, our Bermuda-managed IP holder. But here's a potential snag. If you send money directly from an Irish tax-resident company, Irish Company 2, to a Bermuda-managed Irish Company 1, Ireland can, and often would, slap on a 20% withholding tax. That's a significant bite that our clever architects wanted to avoid at all costs. And this, my friends, is precisely where our Dutch middleman steps onto the stage. The Dutch sandwich. This is the heart of the sandwich metaphor, and it's brilliantly simple in its execution. To bypass that pesky Irish withholding tax, the royalties don't go directly from Irish Company 2 to Irish Company 1. Instead, they take a detour. First, those massive royalty payments travel from Irish Company 2 to the Dutch subsidiary. Because both Ireland and the Netherlands are member states of the European Union, and thanks to specific EU directives designed to facilitate cross-border trade, no withholding tax applies to this payment. It's a smooth, tax-free transfer. The Dutch company, remember, isn't really keeping this money. It's merely a conduit. It simply receives the funds and then, almost immediately, forwards the exact same royalties onward to Irish Company 1. And guess what? Again, because of those same EU laws, this onward transfer from the Dutch entity to Irish Company 1 also avoids any withholding tax. The sole singular purpose of this little hop, skip, and a jump through the Netherlands is to cancel out the 20% withholding tax that would have been levied on a direct Irish-to-Irish payment. It's a legal sleight of hand, a perfectly legitimate detour that saves billions. Lawyers, with their penchant for colorful analogies, nicknamed this the sandwich because the Dutch entity is the thin, crucial slice of ham, nestled comfortably between two thick slices of Irish bread. Without that Dutch ham, the sandwich simply wouldn't work. It would be just two slices of bread, and a very expensive one at that. Stateless income. So, after its brief but critical stop in the Netherlands, the bulk of those royalties finally arrive at their intended destination, Irish Company 1. This is the company incorporated in Ireland but, crucially, managed and controlled from a tax haven like Bermuda. Because it isn't a tax resident anywhere that actually charges corporate tax, neither in Ireland, due to its management location, nor in Bermuda because Bermuda has no corporate income tax. The profit it now holds becomes what accountants famously and rather ominously call stateless income. Think about that for a moment. Stateless income. It's money that, for tax purposes, literally exists nowhere. It's income that has been generated by economic activity, but through this intricate legal dance, it manages to avoid being taxed by any national government. It's a phantom profit, visible on corporate balance sheets, but elusive to tax authorities. When you stack tens of billions of these stateless dollars every single year, the effective tax rate on the entire global structure of these multinational corporations naturally drifts dramatically towards zero. This isn't just a small reduction, it's a near-complete eradication of corporate tax liability on a significant portion of their global earnings. This concept of stateless income was both the genius and the ultimate Achilles heel of this strategy, drawing the ire of governments worldwide. Section 4, a real-world flow. Let's pin some actual numbers on this intricate dance to truly grasp its impact. Imagine Google Deutschland, our hypothetical German sales arm, sells ads for a whopping 10 billion euros, and after local expenses, books 4 billion euros in profit in Munich. Normally, that 4 billion euro German profit would immediately be at risk of a substantial 30% German corporate tax. That's 1.2 billion euros straight to the German treasury. But with our sandwich in play, things look very different. Instead of Google Deutschland directly booking that profit, Google cleverly assigns the actual selling contract, the right to sell those ads, to Irish Company 2. So Irish Company 2 now reports the 4 billion euros as its own profit. But before Ireland can claim its 12.5%, Irish Company 2 immediately pays a massive 3.6 billion euros in royalties to the Dutch subsidiary for the use of Google's intellectual property. This leaves Irish Company 2 with only 400 million euros of taxable profit. On that 400 million euros, Ireland collects its 12.5%, which amounts to a relatively modest 50 million euros. The 3.6 billion euros, meanwhile, travels from the Dutch sub to Irish Company 1, which, as we know, keeps the cash safely in Bermuda, untaxed. So, what's the bottom line? Without the sandwich, Germany would have collected 1.2 billion euros. With the sandwich, Ireland collects 50 million euros, and the remaining 3.6 billion euros simply disappears from the tax radar. One routing decision, one clever legal maneuver, saved Google more than €1 billion in a single year on just this one hypothetical flow. Multiply that across all their European operations, and you can begin to comprehend the sheer scale of the savings. Section 5. Why Ireland played along. So, why did Ireland, a sovereign nation, allow such a significant amount of potential tax revenue to slip through its fingers for so long? It wasn't out of naivete, but a calculated, albeit controversial, economic strategy. Ireland wanted something more than just tax. It desperately wanted jobs, foreign direct investment, and a seat at the table of the global tech economy. By offering a welcoming, albeit complex tax environment, Ireland successfully lured giants like Google, Apple, Pfizer, and countless others to establish significant operations on its shores. These companies didn't just set up paper entities. They hired thousands of highly skilled Irish workers, built state-of-the-art data centers, and invested heavily in infrastructure. Dublin, once a quieter European capital, transformed into a bustling tech hub, earning the moniker Silicon Docks. The Irish government, therefore, quietly tolerated the management and control residency quirk because the employment payoff, the economic growth, and the prestige of hosting these global powerhouses felt far bigger than the corporate tax revenue they might have lost. It was a Faustian bargain for some, but for Ireland it meant economic prosperity, especially after the financial crisis. It was a delicate dance between attracting investment and maintaining fiscal integrity, a dance that continued until external pressure made it simply unbearable. Section 6. The collapse. The party couldn't last forever. By 2015, the intricate layers of the double Irish with a Dutch sandwich had become a glaring target for international scrutiny. The Organization for Economic Cooperation and Development, OECD, a collective of 38 developed countries, labeled the structure a harmful tax practice as part of its broader base erosion and profit-shifting BEPS initiative. This global effort aimed to create a more level playing field and prevent companies from exploiting international tax mismatches. Under immense pressure from the OECD and the European Union, Ireland finally agreed to phase out the scheme. New companies could no longer set up this particular structure after 2015, and existing users were given a generous grace period until the end of 2020 to migrate to alternative arrangements. It was the end of an era for this specific notorious tax dodge. But the corporate appetite for tax optimization, as we've seen, is insatiable. Meanwhile, Apple, another famous user of Irish tax structures, found itself in hot water with the EU. In 2016, the European Commission hit Apple with a massive €13 billion state aid clawback, arguing that Ireland's sweetheart tax deals amounted to illegal state aid. Europe's top court ruled against Apple in the tech giant's 10-year court battle over its tax affairs in Ireland. Apple shares were down about 1%. The double Irish with a Dutch sandwich as a specific structure is indeed toast, but the fundamental drive and ingenuity that invented it, the relentless pursuit of tax efficiency, remains as strong as ever. Thanks for watching. If you found this helpful, click that like button and subscribe for more videos on financial concepts.